Have you ever heard somebody explain something to you, kind of like a financial strategy that just seemed too good to be true, like maybe paying little to no taxes, even if you're a high income earner like a doctor? Well, most high earning professionals, they believe in a simple equation. The more you make, the more taxes you pay. And the idea of legally paying zero taxes, I get often sounds like a scam at first. And I'll admit, that was exactly my mindset until I dove into the realm of real estate and I discovered how the IRS structures deductions and tax benefits, especially for two types of people, business owners and real estate investors. And in this video, I'm going to compare two different scenarios where you can buy a property with cash or with debt and what it could potentially do to your tax situation. If you're new here, I'm Dr. Jeff Anzalone, simply a periodontist on a mission to get you out of the rat race with information and knowledge like this. Do me a favor, download the free passive income guide, links below this video. All right, so let's compare two hypothetical situations. So we're gonna compare investing like Dr. Cash, who, as you can probably imagine, he's paying cash for a $150,000 property versus Dr. Debt, who actually leverages to acquire a $450,000 property. Both of them aiming for a 10% return. All right, so let's break this down. Dr. Cash, so let's put Dr. Cash over here. We'll put this will be Dr. C for Dr. Cash, and this will be Dr. D for Dr. Debt. Okay. So Dr. Cash, he invests $150,000. He's a big Dave Ramsey follower, so he's only going to pay cash for his properties. Nothing wrong with that. Some people are more risk averse than others. So be it. All right. So Dr. Cash, he invests $150,000. He buys a property, and he expects a 10% return, which equates to $15,000 a year. All right. On the other hand, Dr. Debt invests the same amount, $150,000, as a down payment to buy a $450,000 property. He's also expecting a 10% return, which similarly yields $15,000. Now, here comes a little twist in our little tale, something called depreciation. And if you don't know what depreciation is, I've got several other videos on it. But this is really, a lot of times, this is the often overlooked gem in a real estate professional's taxpayer's arsenal. Okay. So while Dr. Cash over here, he enjoys his returns, he has limited depreciation benefits due because he bought his property was $150,000. So his property costs a good bit less. Okay. So his depreciation benefits due to a smaller property value is limited. In contrast, Dr. Debt's larger property value, it's going to offer a bigger depreciation shield. All right, so here's how this works. The IRS allows property investors to write off their property's value over 27 and a half years. This is called straight line depreciation. Now, I'm not going to get into the accelerated depreciation and bonus depreciation and all that stuff. That's other videos. I'm just trying to break this down and keep this as simple as possible for you, okay? So again, for Dr. Cash's investment, again, this is going to mean a smaller amount to have depreciation versus the $450,000 for Dr. Debt, okay? So let me walk you through the math. Let's look a little bit closer at how this works. All right. So let's start with Dr. Cash. Okay. Again, he invests $150,000 in a property. Let's assume that none of this goes towards the land value. Okay. So we're going to keep this as simple as possible because typically when you talk about depreciation, typically part of the depreciation, would be the land. You have to separate it out between the building and the land, you cannot depreciate land. Okay. But in this situation, well, let's just keep this simple. So we're just going to say he's going to get 27 and a half years based on $150,000. Okay. This results in, so if you take $50,000 and we're going to divide it by 27 and a half years, this is going to give you how much depreciation that he's going to be able to take over the next 27 and a half years. And in this situation, let me do it in a different color so that'll actually stand out for us. That's going to be $5,455. All right. So Dr. Cash, because of his situation, he gets a yearly depreciation deduction of $5,455 for the next 27 and a half years. Okay. He has he has an annual income of $15,000 from the property. Okay. Now, after you take that and you apply your depreciation, I'm going to subtract $5,455 from $15,000. So now his taxable income, he doesn't have to pay taxes each year on $15,000. We're going to subtract this out. So now he only pays taxes on 9545. So he gets taxed. 15,000 minus 5,455 is $9,545. All right. Follow me so far? Now, that was Dr. Cash. So let's move on to Dr. Debt. Now, again, he uses $150,000 as a down payment for his $450,000 property. Again, I want to keep this simple. I know we did not take out the land value for the other one, but to keep this as simple as possible so that you can learn, let's say that 400 of the $450,000, $400,000 is attributable to the building, and after excluding the land value for simplicity. So we're going to say the building's worth 400K, and then we're going to say the land is worth 50K. Okay. Again, land is not depreciable, so we'll be able to work with this $400,000. Okay. Again, same scenario. He gets the same $15,000 income, and then after you subtract out the depreciation, Dr. Debt's taxable income. Think about this: is it could be reduced to zero, and then if it's reduced to zero, anything left over can actually be carried forward to offset any future income. All right. So if we take the same thing, we're going to take the $400,000 because we took out the 50, took $400,000, divide it by 27 and a half. That gives us $14,545. Again, he has the same thing. They both had $15,000 of rental income coming in. Remember, we took the 54, 55 over here, subtracted it. So now we take the $14,545 and we subtract it out. It's almost zero. So it's basically next to nothing, right? So in this case, you can see how leveraging can actually help get your taxes little to nothing, but there's more to it. So what most don't consider is the power of leveraging an accelerated depreciation option. Remember, we talked about that a little bit, like cost segregation study. Okay, cost segregation study, they segregate out all the different parts so you can actually depreciate it faster. Again, which can further amplify all these effects. Accelerated depreciation allows for faster write-offs, meaning higher deductions in the initial years. Okay, so in the scenario of Dr. Debt, if he applies cost segregation, he could potentially front load his depreciation deductions in the first few years. It could significantly increase his tax shield. And this could mean, so instead of the standard $14,545, he might be able to deduct a significantly higher amount in the earlier years, again, significantly reducing his taxable rental income even further. Thus, it's going to enhance his cash flow, getting his tax liability to next to nothing. All right. So remember, these are kind of, I'm trying to break this down to you as easy as possible. And while these different strategies that we talked about, they're completely legal, they, as you can imagine, they require careful planning, and often the guidance, and I do recommend you have a guidance of a tax professional. And these different strategies, they actually illustrate how real estate investing can offer all kinds of tax benefits, turning what kind of seems like just regular income from these different properties into legally protected earnings that, if you continue to do this throughout your career, completely enhance your wealth without increasing your tax burden. So think about this: if you're making $150,000 a year and you keep increasing your income, again, just like we started talking about in the beginning, the more you make, the more taxes you pay. But with real estate, the more that you invest in, the higher your property's value, not the more taxes, the less taxes you're able to invest in. And so it's the opposite effect. And again, it took me a while to wrap that mindset, around my brain, because it's just been so ingrained as, oh yeah, a lot of times people will, kind of stick their chest out and stuff and say, oh yeah, I pay, $400,000. Man, I paid $1 million in taxes this year. And they think that's cool. And back before I understood all this, I was like, man, if he's paying $1 million in taxes, this guy's making a ton of money. Now, when I hear that, I'm like, man, you're stupid, because you don't understand how the tax game works. Okay. So once you understand how this works and all the different nuances in it, again, you don't have to learn all of it, but you need to learn enough to where you can go find a professional to help you do this. And if you need one, I'll link the link below this video of the one that I personally use. But if you're happy with yours and he or she knows about real estate and understands this concept, use them. Get them to teach you along the way when you're looking at your tax return what all this means. Okay. Now, I know this was as simplistic view as we could get as possible. And remember, I talked a little bit about cost segregation and actually accelerating this from 27 and a half years to even quicker. So if you want to learn more about how accelerated depreciation using a cost segregation study can save you even more taxes, do me a favor, check out this next video.